For most of us, automating our investments will probably be one of the best financial decisions we ever make, because once income comes in, money can either disappear without intention or it can be directed towards the life that we're trying to build. Every month, my money gets allocated into different buckets. Some goes into long-term growth, some goes into income-producing assets, and some goes into safer places while I work towards short-term goals. And over time, this simple system has helped me build my portfolio steadily without needing to predict markets or chase trends. So in today's video, I want to break down exactly what I invest in monthly, how much goes where, and more importantly, why each bucket exists. Today's video isn't just about copying my numbers, it's about showing you how one person structures money around real life goals, and I hope it will help you structure yours as well. Without further ado, let's dive right in. Let's go. What I invest in monthly today looks very different from when I first started. In my earlier days, my focus was simply saving up enough cash to leave my corporate job. Then it became building core index fund exposure, then dividend income, and now in this current season of life, I'm balancing investing while preparing for a home purchase back in Singapore. My portfolio evolves as my life evolves. So let's start from the smallest amount. $100 a month goes into my general investing portfolio with Stashaway. This portfolio exists mainly for one reason: diversification. My existing investments are already heavily concentrated in the Singapore and US markets, so I wanted a hands-off way to add broader exposure beyond what I was already investing in. I tried individual stock picking before, and honestly, it wasn't my thing. Too much attention, too much noise, and not how I personally would have wanted to build long-term wealth. So this became a small step towards diversification in a way that suited my personality better. And yes, before the comments come in, I know that a managed portfolio has its own pros and cons. I did cover it in a video before when I shared with you guys that I was starting this monthly investments. This was meant to be a 1-year experiment, and honestly, it's crazy to think that it's already been a year. For this portfolio, I chose a 22% risk index. On their scale, it ranges from 6.5% for more conservative portfolios to 36% for more aggressive ones. I personally chose 22% because I wanted a balanced approach, with US exposure making less than half of the entire portfolio. This is what works for me. Everyone's goals and risk tolerance are different, so make sure you understand yours before investing. So far, I've invested a total of $1,300, and the portfolio is now valued at $1,403.67. If you compare against capital invested, the return works out to be around 7.7%, but since I invested monthly instead of all at once, it's more accurate to look at money-weighted return, which is at 15.29%. Over the past 12 months, this portfolio returned 18.4% in USD and 13.5% in SGD, outperforming its benchmark despite all the volatility that we have seen this year. But honestly, returns was never the main takeaway here. Instead, it was this. Even with small monthly amounts, in my case it's $100 a month, it's still possible to build a diversified portfolio, because if you try multiple ETF, bonds, commodities, and global markets yourself with only $100 a month, it can be harder to do efficiently. Whereas with a managed portfolio like general investing by Stashaway, you can start small, stay consistent, and get broad diversification from day one. I'll likely continue this monthly for the foreseeable future. And here's the interesting part I recently discovered. Stashaway launched something called Regular Investing Advantage, which rewards investors who consistently invest. Here's how it works. For every dollar invested into an eligible portfolio like my general investing one, the same amount invested in Stashaway's cash management portfolio, Simple or Simple Plus, receives an additional 0.15% per annum boost on top of the projected rate. For example, with Simple Plus, you could earn 2.85% per annum yield to maturity. If you invested $500 this month, the same amount in Simple or Simple Plus earns the extra 0.15% per annum boost. And if you invest another $500 next month, $1,000 in total of your cash gets boosted. So the boosted amount stacks as long as you keep investing. And no, Regular Investing Advantage isn't just a temporary promotion, it's a permanent benefit from Stashaway. I think it's great that Stashaway is encouraging regular investing, something that I truly believe in and practice myself. Find your investment style based on your risk appetite, do it regularly, and don't overthink it. I'm mainly focusing on consistency and patience to build long-term wealth, not overnight success. If you're looking to kickstart something on Stashaway, I am an affiliate partner, as usual, with brands that I personally use. You can use the link in the description box below to get your first 6 months managed for free. So this is the first investment, $100 a month in Stashaway's general investing portfolio. Second is my gift to my nieces. $150 a month goes into an index fund ETF tracking the S&P 500 until they turn 18 or 21, but we'll see how things are then. This is fully automated through Mumu's regular savings plan, the same platform I use to grow my dividend portfolio. More than returns, it's about giving them something meaningful, a small head start when they are in their 20s. Sometimes money can also represent love, family, and future opportunities for the people that you care about. For more details, you can refer to this video where I shared the mindsets and the heart behind this portfolio. For me, I wanted a clear separation between money that's meant for them and money that's meant for future me. I started this in February this year, and right now it's up 7%. And again, you'll notice a pattern here, automation, because I'd rather let systems handle recurring actions so I can focus and give energy to other parts of my life. And lastly, it's my US investments. This might be something new for those of you who have been following me for some time. I actually started a Nasdaq position the same time that I began investing into the S&P 500 through Interactive Brokers back in July 2024. It definitely overlaps with my S&P 500 portfolio, but I wanted a small portion of my monthly investment to go into something a little bit more aggressive. So for those of you who do not know, the simple difference is this. S&P 500 gives exposure to around 500 of the largest US companies across different sectors like finance, healthcare, consumer goods, industrials, and technology, whereas Nasdaq 100 focuses on 100 large non-financial companies listed on the Nasdaq exchange with heavier exposure into technology and growth names. So the S&P 500 is usually seen as broader and more diversified, while the Nasdaq 100 tends to be more concentrated and can move more aggressively in both directions. For me, this isn't replacing the S&P 500. It's just a smaller side allocation for a bit more growth potential, while understanding that it may come with more volatility as well. I'm investing 500 USD, roughly around 630 Singapore dollars, into the Nasdaq 100, and on top of that, 2,000 USD, roughly around 2,005 Singapore dollars a month, goes into the S&P 500. And overall, as of the time of recording this, I think both is up 20%. Hold on, let me pull the screenshot. I'm filming this on a Saturday, market closed last night, and right now CSPX, the S&P 500 portfolio I'm investing in, is up 19.9% and the Nasdaq 100 is up 21.8%. So there's a slight difference as you can see here. Nasdaq 100 moves a little bit more than the S&P 500 because of how concentrated it is. It's more volatile as well. So correspondingly, when market drops, this will drop more than the S&P 500. So every month, a total of $3,380 is automatically invested into the different buckets, all meant for different purposes. Some for long-term growth, some for my nieces, some for diversification, and some for stability. The only portfolio I manage more manually is my dividend portfolio. I don't invest into it monthly because each purchase is usually in 100 shares, and sometimes it's simply more cost efficient to wait until I've built a lump sum to invest into my current stock holdings. Also because in this current season of my life, I'm actively saving up for my house down payment and renovation costs. So I'm trying to hold myself back and not invest any amounts into the market, even though just a few days ago I did something. But my own system will probably continue evolving as my life changes, especially with the home purchase coming up this year and different priorities that I have as I age. I'm 30 this year and it's crazy to think that I'm already in my 30s. But anyway, the foundation stays the same. Automate what I can, keep investing consistently, stay diversified, and let time do the heavy lifting. Everyone's numbers, goals, and timeline will look very different. But if there's one thing I've learned, it's that progress often comes from building a system, one that you can stick to and not chase perfection. Don't look at what others are doing, focus on yourself and your personal goals. I hope this video helps you one way or another. If you have any questions, leave it down in the comment section below. You can follow me on Instagram where I do a little bit more active update more than once a week, or my Telegram channel over here as well. And as always, have a great week ahead and I'll see you guys in my next video. Bye bye.